Good morning and welcome to this Wednesday, April 14th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, we got futures looking pretty good. Last time I looked anyway, let me double check and see. Well, the Dow's under a little bit of pressure. A couple of the big financial names, even though they had tremendous earnings reports, and we'll go through all that later in the show, not getting tremendous reaction. And that's always the risk holding any stock into an earnings report. It may not seem right, but stocks don't react necessarily based on an earnings beat or an earnings miss. Sometimes a lot of that's already built in. And we've seen many financial stocks already making big runs heading into earnings. So it's always a question in my mind whether everything's already been built in, and that's what you have to guard against. So anyway, earnings season just kicking off this morning. We got some big earnings reports we'll go over in just a little bit. But first, before we get into any of that, let me take you over to Earnings Beats. And for those of you who are new to Earnings Beats, would love to have you join our Earnings Beats Digest community. This is our free newsletter. Simply type in your name, email address, hit the subscribe button, and we will make sure we get our Earnings Beats Digest newsletter out to you 3 times a week, Mondays, Wednesdays, and Fridays in the morning, usually before the market opens. Just focusing on earnings, of course, and relative strength and anything that, anything we consider interesting. A lot of times I'll look at industry groups, or maybe I'll look at seasonality. I mean, there's lots of different things that we like to feature at Earnings Beats, but we do try to make it very educational, and many times they provide you some great trading opportunities. I can certainly point to one just about 2 weeks ago when I wrote about Tesla and their pre-earnings runs and how they average about 50% over the last 5 quarters, 50% average gains in the 4 weeks leading up to earnings. That's the period we're in right now. And when we move over to the daily market recap, you can see over here, here's Tesla. This is when I wrote the article. Look at where I think it was March 29th. So Tesla is doing exactly what it does, which is makes pre-earnings runs. And then most of the time after the earnings come out, which have been over the past 5 quarters pretty strong, the stock tends to sell off. So you need to be aware of how the market works. It doesn't always react the way you think it's supposed to react. And that's why many folks who don't study the stock market and don't realize how it works get very frustrated. They think it's rigged because they don't understand it. But anyway, Tesla, you can see they're having a big day. But let's go back, take a look at the Dow. Dow Jones was down 68 points, but still very, very close to record high territory. The S&P 500, a new high, closing at 4141, first time ever at that level, closing on the S&P 500. The NASDAQ up more than 1% yesterday. We have been on a tear on the NASDAQ, with growth stocks starting to close the gap on the value stocks. Value stocks had been under accumulation for the past, 4-6 weeks. And growth stocks took a backseat. All that talk about how higher interest rates were horrible for growth stocks. Well, interest rates still up at 1.63%, not too far from the recent high. And all of a sudden, growth stocks are back in favor. But NASDAQ did close at 13,996. So almost back above the 14,000 level and getting very close to that February high. And with the momentum behind many of these FANG stocks, Amazon and Apple and Google and so forth, got to believe that it's only a matter of time before we see the NASDAQ breaking out to a new high again. Look at mid caps. Kind of a little interesting because mid caps and small caps, for the most part, were running together. But if you look at the last 3 weeks or so, you can see the 50-day test on mid caps right back up to their prior high. Small caps, nice little reversal off the 50-day, but struggling on a relative basis. I mean, literally the last 2 weeks, small caps have gone sideways while mid caps have continued to rally. So that's an interesting change that's been taking place, and it'll be worthwhile to see if that continues. I believe small caps are setting up for another buy, because when you're in a secular bull market, it's simply rotation back and forth to different areas. One area cool off, another area heats up. And so when you get a big run in an area, don't be afraid to start peeling some profits off, and looking for other areas that maybe haven't been participating. And I think small caps kind of fit that category right now. So small caps, and part of this is energy. There are a lot of small cap energy companies, and energy has really struggled. I don't have energy up here on this summary from yesterday, but when energy weakens, sometimes small caps tend to struggle. And you can see that big move we had earlier in the year in small caps coincided with pretty good move up in energy as well. Looking at the sectors, utilities led yesterday, and I get this question a lot of times, well, isn't it bad when the stock market's being led by utilities or by any of the defensive groups? Well, day to day, it's not going to really make a difference. Now, if we're talking about, if 1 month from now, all the major indices are at record highs and the 1 month leaders have been utilities and consumer staples and real estate, maybe healthcare, then yeah, that's a problem. That would be a warning sign to me. But for one day, no. I mean, everything's going higher, and that's what we expect in a secular bull market. So don't be upset because utilities, look what utilities were doing back in February, breaking to new multi-month lows. It's okay for the group to come back and break out again. That's fine. More important is what's going on with consumer discretionary, which is breaking out in a straight line higher as we head into earnings season, and what technology does. And I don't want to let cat out of the bag, but we got some projects going on at Earnings Beats right now, some pretty amazing stats that we're going to have for you fairly soon on the seasonality and how various sectors perform during earnings season and leading up to earnings season and so forth. So we got a lot of things working right now. I don't want to talk too much about it, and I certainly am not putting a time frame on it, but I do want to try to get that out fairly soon. And I'll be talking about some of the things that we've been finding over the next couple of days to couple of weeks as well. But this is not a surprise at all to see discretionary and technology making these moves as we head toward earnings season. And remember how bad it was in March? Yeah, all that's been forgotten. That was March. That's not April. Kind of amazing again how the market works. Look at the autos. Autos making a big break. I wanted to point this one out because autos, like Tesla, autos pretty much being led by Tesla, on that downtrend back in February and then the attempted recovery in March, you can see several tops just above 900 on the auto index and several tops on Tesla right just above 700. Both of those were cleared yesterday, and you can see volume picking up on both charts over at least the last week, 2 weeks. So really good volume coming in, breaking back above moving averages. Look at the PPOs turning positive. Both the auto PPO and the Tesla PPO both went positive here with this breakout. So great action in that area of the market. And of course, Tesla reports, I think it's on April 27th, I believe. I have to go back and double check that, but it's something like that. In a couple of weeks, Tesla will be reporting. And you can see big move here in anticipation of that. And last time I looked, Tesla was up another $20 pre-market. That was probably 30 minutes ago. But so it looks like Tesla could be tacking on more gains as it moves up, tries to get through that 800 level. I think 800 actually, because of this low at the beginning of February, before we went back up one more time, and then we broke down below this 800 level, we might struggle short term at 800, pull back, and then have one more push heading toward earnings. All right, 10-year Treasury yield. First of all, no economic reports out today, so not a whole lot for the bond market to be churning and thinking about today. I will say, though, the 10-year Treasury yield yesterday closed below its 20-day moving average for the first time since back at the end of January. And I've been talking about that with this PPO weakening to watch to see if we break below that 20. If we can't get back up above that 20 today, I think we have a chance on the 10-year Treasury yield, maybe move back to about 1.5%. That would probably give us that 50-day test. It would also give us a center line reset on the PPO, or maybe be close to that. So those are some things I'd be looking for on the 10-year Treasury yield. And of course, if the yield goes down, well, growth stocks were out of favor when the yield was going up. So it only makes sense that growth stocks should do well, if we continue to pull back. And I think that will be the case because The problem is when yields are going down, that really makes it more difficult for financials. And that's been one of the areas that led us during the first quarter of this year. And, it's pretty easy to see why. Look at the move that the 10-year Treasury yield made in the first quarter of this year. So financials reacted to that. Now we're getting really good news out with earnings. Again, I'll go over those in just a little bit. But as a result, I just think a lot of good news is built in to many of these financials. So don't be surprised if financials, lag in the near term, but are still, I believe, very, very solid going forward. Because I don't think this pullback in 10-year Treasury yield is going to last. I don't think we're going right back down to 1%. I think we're going to pause, consolidate these gains, and I think 10-year Treasury yield goes higher. I think we're heading for 2%, maybe 2.5% in 2021. And I completely disagree with a lot of the folks, talking about these interest rates throttling growth stocks. I don't see that at all. Not with the kind of growth you're going to see. Wait until I show you some of these earnings that came out in the banking area. I mean, my gosh. And then Citi Trends raised their guidance. I'll show you that chart in just a second. But Citi Trends raised their guidance for the first quarter, both revenues and earnings per share higher. And so I think the numbers are going to continue to be very strong in the financial space, and they're going to perform well, I think, in 2021. I think the backdrop will be really good for financials, continue to be strong. But that's a group that's been leading. It's their turn to pause. And so everyone who's been jumping in because of the strength now is going to have to sit and wait through probably a period of consolidation. All right, let me pull up that Citi Trends chart for you. Show you. So this morning they just came out, they raised guidance. I think last time I looked, they were up 8% in pre-market. Look at the chart. This is why I always say technicals precede fundamentals. Price actions going up. Now the news comes out, they're raising guidance. The reason that this happens is you've got Wall Street analysts meeting with management teams. They know what's going on in these companies. They know the management teams aren't going to play their poker face. They're not going to say, well, think to themselves, we're doing great, but I don't want to tell the analysts that. No, it's in their own best interest to let the analysts know that, hey, we're having a really good quarter. We see things really strong down the road. Wall Street takes that information and then they start buying for their own accounts and for their clients' accounts before the news comes out that Citi Trends is raising their guidance. So you've got to follow the charts. You've got to follow relative strength. You got to follow accumulation distribution. I think that's another important factor. Is that supporting price action? So all of those things I think are really important in the market. All right, let's move on to talking technically. I want to talk about gold. I had a couple questions come in recently saying, gold's been really rough for a while. We got a double bottom in. That was one specific question that came in. We have a double bottom, and you can see that right here. So now is the time to put money into gold. Personally, for me, no, I'm not interested, and I'll tell you why in a minute. As a short-term trader, what I would say is you've got this double bottom. We did make this breakout above this prior high. And when we pulled back, we held that 20-day. Looked like we were breaking down below the 20-day, but now we've held it. And, so I'd say in the short term, the very short term, I would say the trend is bullish here on gold. But if we roll back over and take out the lows from yesterday or Monday, I would completely change my opinion on that. I am counting in the near term on gold holding its rising 20-day moving average. You can see that 20-day had been going down and it's starting to turn back up again. If we're trending higher, we should continue to trend above that. And I wouldn't even care if it's just a head fake. Anything below recent prices, yesterday's low, I would be out. I'm just not a fan of gold. And so I'm not going to make excuses for a group that I'm not interested in, that I don't like. Sometimes I'll make excuses. I've been making excuses for Zoom for quite a while. I can tell you that because it's been a pretty good position of mine. And that finally made a move yesterday along with Tesla. But it's because I believe in what the company does. I believe in the long-term chart. There's a lot of things that I can fall back on. If it's a bad decision for me to hang on to Zoom, then, I got nobody to blame but myself. With gold, It's just not a good looking chart. Now you're looking at an absolute chart here with the double bottom. We went up to the 50-day. You can see the PPOs near the center line. Hey, we did this before when we were coming down here. Look at these 50-day tests. Look at that head fake. PPO actually went positive right before another big drop. And then we came back up, went through the moving averages again. Couldn't get through that prior high, double top, right back down again. So I just think you've got to be more nimble with gold. You're in a downtrend on an absolute chart. And if we move to a relative chart, this is where I have the big problem with gold. The thing I always talk about at Earnings Beats is I'm trying to beat the S&P 500. Whether I'm investing in stocks, ETFs, whatever it is, I'm trying to beat the S&P 500. Because if I can't beat the S&P 500, then I should just invest in the S&P 500 and go golfing every day. I mean, otherwise, I'm just spending a lot of time spinning my wheels. If I'm not building my financial future and I'm not doing it at a rate that beats the S&P 500, then I should just put my money in the spider and go golfing or play tennis or hiking or go to an island and go, whatever you like to do. That's the way I look at the market. So I use the S&P 500 as a benchmark. Look at gold relative to the S&P 500. Now, when the pandemic hit, gold, anytime there's extreme fear in the market, money runs for gold. That's one thing you need to understand. That's not the only reason people buy gold, but that is one very important reason why people will buy gold. Fear, extreme fear. We saw that during the pandemic. Since then, look at the relative strength. I mean, we had a little good period here, June through early August, but for the most part, we are consistently underperforming the S&P 500. And even when you look at the recent strength here, even the last month, moving back up a little bit, that's still going down versus the S&P. So if I'm trying to beat the S&P 500, this is not the area I want to try to do it with. Now, if you are saying, hey, I want to take a shot with some gold stocks, okay, well, you can go over to the scooters. And this is the Scooter Reports large cap stocks. Just type in gold mining. And Newmont Mining comes up as one large cap stock. Scooter 11. Obviously, it's not a very good one, but it is a gold miner, large cap that you could look at. Go into the mid caps. Got 2 in the 80s. Everything else is below 20. So if I was thinking about gold, I would probably consider either Sibanye, Stillwater, or First Majestic Silver. And so the first one I'd look at, it's uptrending. It's in a nice pattern. If it broke below 17, I wouldn't like it much. But this one's going against the grain. So yeah, this is a stock that I could get behind. It would be a case-by-case basis, and I'd have a tight stop. I would not be taking big chances in gold because you're not in a group that's outperforming. Makes it much more difficult and much riskier, in my opinion. All right, I'm going to move on to sectors. I want to look at sector relative strength because I've talked a little bit about relative strength. And you can see technology, which did make that dip below the 50-day, now is back up above its 20 and its 50. This is great configuration right now. Relative strength on technology has moved above its 20, which is starting to turn up. It's above its 50, which is already moving up. And look at the relative PPO bouncing off the center line, starting to turn up. So we're seeing that money rotating back into technology. And I think that's a really good sign as we head toward earnings season. I think we're going to see some big numbers coming out from every area of the market, or most areas of the market, but particularly technology and consumer discretionary. Speaking of consumer discretionary, look at this relative move since March. Again, the 20 never crossed below the 50, and price action, relative price action, right back up above both. Everything turning higher. The only difference here is that we need to see that relative PPO turn positive, but I think it's just a matter of time. I think it's going to happen. We're already turning up. I think probably in the next few days, probably we'll be back up above. On an absolute basis, down here at the bottom of the chart, you can see consumer discretionary breaking out to new high. Communication services, still above the 20, which is above the 50. Relative PPO strong. Nothing wrong at all with this chart. Not as strong, obviously, as technology and consumer discretionary over the past few weeks. You can see we topped on a relative basis. but on an absolute basis, we're setting new highs. That's the difference and a key difference between absolute strength and relative strength. Communication services is breaking out, but so is the S&P 500. So is communication services leading the S&P 500, or is it being dragged higher by the S&P 500? Two different scenarios. And the relative strength chart is what tells you whether it's leading or it's being dragged higher. And in this case, over the last few weeks, it's being dragged higher. But if you look back over the last year, this is a group that's been leading, and it's an aggressive group. We're in a secular bull market, so this is a group I would look for leadership from. Same goes with industrials. Nice strength leading throughout this, most of this move since May of last year. But last few weeks, seeing a little bit of move down, even though we're moving to new highs. We're moving up. We're just not moving up as fast as the S&P. Money on a relative basis rotating out of communication services, out of industrials, and out of financials. Right here, financials set a new high, but look at the relative strength line. So the money is rotating out of these last three groups and into technology and consumer discretionary. This is what makes up a secular bull market. The aggressive groups are all going higher, and they're just taking turns leading. Great action. I'm going to go through and just show you the technical or technology sector, and I'm going to show you the relative strength of the industry groups here, and then we'll move on. Want to get into a little bit of seasonality quickly. So here you can see this is computer services on a relative basis. The last 3 years been going down. So I'm going to move on. It's not to say there aren't good stocks in that space. I think Zoom's in that space, and Zoom's starting to show some strength again. But I'd much prefer a group like semiconductors. I mean, this group relative to the S&P 500 has been money for the last 20 months, almost 2 years, really since May of 2019. So 23 months. If you've been in semiconductors, if you are consistently investing in semiconductors over the last 2 years, you're doing very well with that part of your portfolio. Software starting to strengthen. Look at that move back up through the 20. I'm just looking at this whole period as just relative consolidation. I don't think it's bad, but after the strength that we saw in software, it's been frustrating if you've been trying to trade software stocks. Some are going up, some are going down. You got Microsoft still doing really well, breaking out the new highs, but then you have some of the smaller ones that have struggled on a relative basis. So we've been going sideways, but I do like, at least in the near term, this push back to the upside. And the thing that I think could really help software is that we finally just broke out above that February high. So a lot of this relative weakness was the period of consolidation that we went through in February and March. Now that we've broken out again, look at the relative strength building. Pretty good sign for software. Then we get into electronic equipment. This has been a really good group, but over the past 2 months, we're seeing relative weakness, not absolute weakness. We just broke out again, but we're not, things are just slowing down. The group isn't moving up as fast. And so it's losing a little bit of relative steam. That's good. That's fine. Nothing wrong with the group. Computer hardware, same as software, really. Very similar looking charts, topping several months ago on a relative basis, going sideways. Haven't made the breakout here, but if we do, keep an eye on Apple. Apple's starting to strengthen. I think we're going to see another or continued surge in Apple. Electrical components, been very strong, but like a couple of the other groups, we're seeing just a little bit of short-term relative weakness, absolute strength, breaking out, relative weakness, not performing as well as the S&P 500. Last one, telecom equipment, did make a little bit of a surge in March, but here over the past few weeks, breaking back down. This is a good move because it did clear 2-year highs, that were established back in July of 2019. So I think that's a good move. I really like to see it hold this rising relative 20-week moving average and then turn back up and see that 20 crossover. Don't get me wrong, we got some improvement going on in this group, but it's not as strong. I'm not as confident as I am semiconductors or software, computer hardware. All right, let's move on to seasonality. And first thing I want to tell you, I've gone over this before, but in the month of April, April 1st to the 6th, annualized return on the S&P 500, 31.41%. April 7th to the 11th, annualized return on the S&P 500, 18.54%. Again, this is going back 7 decades. April 12th to the 18th, which is the period we're in right now, this is the strongest part of April. Annualized return, 41.19%. And by the way, 61% of the days go higher. The trading days that fall between April 12th and the 18th, going back to 1950, 61% of the days in this period go higher. Now, only 53.5% of all days during the calendar year go higher on the S&P since 1950. So you can kind of get a sense, 61%, that's 8 percentage points higher. I think statistically that's pretty relevant. So there's a much better chance that the S&P is going to rise during this period, and the annualized return, 41%, is more than 4 times, about 4.5 times, the S&P 500's normal annual return of 9%. So this is a strong period we're in right now. April 19th to the 24th, annualized return minus 6.3%, minus 6.3%, and only 49% of days go higher. So as we get closer to the 19th, which, that's right after options expire, it's Monday after options expire. I think we're probably going to have a pretty good week this week, but I think once we get into next week, we might see a little bit of hesitation. The market's getting a little ahead of itself. History tells us to be a little careful. So don't be afraid to book some profits. Maybe hold on to some, book some, keeps going higher. You're still making money. If it pulls back, you got some cash available. April 25th to the 30th, 13% annualized return. So as we get into the end of April, and then the start of May is pretty strong as well. Ignore the go away in May. That rhymes. It sounds really cute. I am not a fan of the go away in May. I do think that there are periods when May to end of October is not as strong, not nearly as strong as November to April. That is a fact. And so that is just taken and blown completely out of context to get out beginning of May because of this. May's not a bad month. June's not a bad month. You start getting into the middle of July and throughout the rest of the summer toward late September, that's the period that really struggles. And I'm not just guessing at it. I've got all the data in my spreadsheet to back me up. So keep all that in mind. The other thing I was going to do is just show you the seasonality chart list. Well, this is offered to all of our members that, you can download it into your stock charts account if you have one. Many of these stocks really doing well though this month. Etsy, you can see, was the top performer. Etsy, since going public, has never had a down April. 7 for 7, I think. I think this might be the 8th April for Etsy. But you can see so far looking pretty good, tacking on more gains in April. One stock that was on this list was Amazon. Look at Amazon's April. Not too shabby. Amazon averages over the last 20 years, averages going up 9.2% just during the month of April. This month, we're probably already up 9%, pretty close to it. So this is typical. It's, I don't think seasonality is the end all be all. I wouldn't do all my trading simply based on seasonality. I don't think that would be smart at all, but it's another indicator. It's something that you should be aware of. Makes you a better trader or better investor. All right, moving on. Let's talk a little bit about earnings. JP Morgan. Ready for this number? First of all, revenues, $32.3 billion. Market was expecting $29.9 billion. Pretty easy beat on revenues. Earnings per share. All these folks talking about how the market's overpriced based on PE ratios. Well, the E part of that ratio is going to be changing. And that's why high PE ratios don't always mean a topping market. In fact, many times it is a sign of an expanding economy and economic strength ahead. JP Morgan earnings per share was expected at $3.05. They posted $4.50. 50% above estimates. And last time I looked, JP Morgan, well, we can pull it up here because the market just opened. But JP Morgan was down 0.5%. They reduced their provision for credit losses by $4.2 billion. That was the net. It went right to their bottom line. Banks tend to be very conservative. So when you look back through the pandemic, they weren't writing off loans, but they were providing for loan losses. That's what the provision for credit losses is. So JP Morgan had already taken a hit for something that never even materialized. That's kind of required. That's the Federal Reserve comes in and audits banks, and they will tell banks that this is going in your provision for credit losses. They kind of suggest it in a very forceful way, like you will be doing this. And I say it because I audited banks and I worked with regulators of the Federal Reserve. So I'm familiar with how banks work. Anyway, because the economy's strengthening, things are looking up for a lot of companies. They actually reverse some of those. So a lot of this is just an accounting transaction. It's no cash coming in or anything, but it's still good news for a bank as the economy improves to be able to reduce your loan loss provision. Anyway, that's a huge beat. And you want to hear a really good one? How about Goldman Sachs? All right, revenues expected 11.7 billion. They posted 17.7 billion. Earnings per share, 9.79 was expected. How about 18.60? You see how maybe these PE ratios might get adjusted a little bit? Not only that, but when you beat like this, what do you think that does to your future estimates? I know when I look at numbers like this, I would be thinking, oh, I need to revise my estimates going forward by significant amounts. If I thought it was going to be $3.05 for JP Morgan, it comes in at $4.50. I got to go back and review my entire future earnings growth picture, and probably substantially. And yet the media would have us believe that interest rates going from 1% to 1.7% is going to somehow materially change the valuation of these companies that are posting these huge earnings growth numbers. I just don't see it. I have said it all along, don't see it. And I'm going to stick to my guns. I think growth is where it's at. And some of these companies that you might think of as value are suddenly more growth oriented, and they're going to get rewarded. JP Morgan, let me get you an update now. I was waiting just so I can make sure, see where it opens. But JP Morgan has been rewarded. Look at this move. And I talk about, buy on rumor, sell on news. Well, this was everyone getting in knowing that the numbers were coming for JP Morgan. Now the numbers are out. It's like, oh, ho hum. Who cares? And so anybody who's been buying over the last couple months, if this continues and we see JP Morgan sell off for another few days, they're going to get very frustrated, especially if they see Tesla going up, because now they're going to be like, oh, I need to be on Tesla. Then, of course, they get out of JP Morgan, they go into Tesla, and then the roles reverse. Then JP Morgan goes up, Tesla comes down. I mean, it's unfortunately the way the market works. Goldman Sachs, let's look at that reaction. And Goldman Sachs is up a little bit. That was a huge number. But once again, this is a stock that back, when the vaccine news came out, November 9th, was trading at 210. 3 weeks ago, we were at 360 almost. Lots of anticipation for strong earnings. So it's already built in. But again, folks will get frustrated. Let's look at Wells Fargo. Wells Fargo is starting to look like a much better bank to me. And this is one that had been underperforming its bank peers for a long time, but I'm beginning to see some really good action in Wells Fargo. They beat on their top line, bottom line, $1.05 versus 69 cents. Again, 50% beat. That's big when you start looking at valuations. One company not faring so well is Bed Bath & Beyond. They missed their revenue estimate. They did beat on the bottom line, 40 cents versus 27 cents, but then they guided their revenues lower. And you can see the stock down 14%, and actually gapping below these recent lows. So I think short term, Bed Bath and Beyond probably going to have some issues. I think we could be heading back into the upper teens. And at that point, depending on what technicals are suggesting, maybe that would be a time to consider the stock. One very positive reaction, at least in pre-market, was the Lovesac company, LOVE. They beat on the top line, crushed the bottom line. Market expecting 56 cents. They came in at $1.37. They were up 8% in pre-market, but they didn't translate into the open. Pulled back. I actually think it's probably that pullback on the 20-day was a great opportunity, because this is a stock that's been consolidating for 3 months. And with those kinds of numbers, I wouldn't be surprised to see this one maybe moving higher and breaking out again. AD line looks really good too as well. All right, 3 you must see, and let's wrap this thing up. United Health Group. These are 3 companies that will be reporting earnings tomorrow. And I am in my glory. If I sound like I got a little bounce in my step today, I love earnings season. So once earnings start coming in and all these companies start reporting, it's just so much excitement, so many things changing in terms of our strong earnings chart list, the companies that we want to be aware of, to trade or that go into our portfolios. So this is really the time of the year. Next 6 weeks, or time of the quarter, I should say. Next 6 weeks are going to be really big. Anyhow, UNH reports tomorrow. I think the chart looks pretty good. Been moving up, came back down, got a nice little cup, bounced off the 20-day. Not excited about the accumulation distribution and relative strength. While it's not that great versus the S&P 500, it has been bouncing, by the way. It definitely is bouncing versus its peers. So I would say this is a stock that, if you're looking at healthcare providers, I would say that you want to be looking at this report as maybe something that could be a catalyst for the group, because this is, Wall Street starting to put money into this group on a relative basis, or into the stock on a relative basis. And if it breaks out with earnings, that could be a good sign for the stock. Pepsi. Pepsi, not as big a fan. I mean, we still haven't taken out the December high. I mean, this was the pandemic low. We have not done much on Pepsi, and you can kind of see that relative to the S&P 500. I wouldn't be expecting a whole lot of that out of that report. And then the last one, Alcoa. We know many of the material stocks have been on fire, for the last few months, several months, and Alcoa is one of those. So when you look at the relative strength, Alcoa is aluminum. So that's why you don't see any relative changes here. But the index moving up and Alcoa moving up relative to the S&P 500, that's really important. So I would expect a good report out of Alcoa. All right, let's get a quick update. What's going on in the market? See if the NASDAQ made 14,000. It has. Only 10 points though, so not much. But we are above 14,000 there. NASDAQ 100 down 12, still has a little bit of work to do to get above that 14,000 level. So let's see. Small caps, mid caps though, we're starting to see a little bit more action there. That's a good sign. Anyhow, that's it for me today. Everybody have a great rest of your trading day. Be following these earnings reports. That changes the landscape in the market, no doubt about it. I'll be back tomorrow over at Stock Charts TV for your next Trading Places Live. That will start at 9 a.m. Eastern, as all of these do. So I'll hopefully see you there. Take care, everybody. Happy trading.